All right, this is about a mechanism unfolding right now across the U.S. banking system that most Americans won't notice until it directly affects their ability to access money they believe is theirs. Credit card limits are being reduced systematically, not as isolated decisions by individual banks reviewing individual accounts, but as a coordinated response to stress building inside the consumer credit system. This is not about missed payments or bad behavior on your part. This is about banks preparing their balance sheets for what they see coming in the household debt structure, and the implications for retirement planning are more severe than almost anything being discussed in the financial media right now. Between January and December of 2025, the six largest credit card issuers in the United States reduced total available credit by $87 billion. That number comes from Federal Reserve data on revolving credit facilities, and it represents the largest single-year contraction in consumer credit availability outside of the 2008 financial crisis. What makes this different from 2008 is the mechanism. In 2008, banks cut limits after defaults spiked. Right now, they are cutting limits before defaults have fully materialized. They are acting preemptively, and that tells you everything you need to know about what the data inside these institutions is showing them. If you are over the age of 55 and you are counting on available credit as a bridge tool in your retirement income plan, if you were planning to use a home equity line during a market downturn to avoid selling investments at a loss, if you were assuming that the credit access you have today would still be there in 18 months, you need to understand that assumption is being invalidated in real time. This is not speculation. This is not theory. This is a structural shift in how consumer credit operates in a high-debt, high-rate environment, and it has direct consequences for sequence of returns risk, for liquidity planning, and for the financial independence timeline of millions of households currently in the retirement red zone. Over the next 12 minutes, I am going to walk you through exactly why this is happening, what the credit contraction cycle looks like based on historical precedent, and what specific actions you need to take this month, not next quarter, to protect your retirement plan from a liquidity event you cannot control. This is not about panic. This is about understanding how the system works when stress builds, and positioning accordingly before the options narrow. The framework that explains what is happening right now is called the credit availability cycle, and it operates independently from your personal creditworthiness. Most people believe that credit limits are a reflection of their financial responsibility. You pay on time, your score is high, your limit stays stable or increases. That is true in a steady state environment. But when systemic stress enters the credit market, banks shift from individual risk assessment to portfolio risk management. They start modeling aggregate loss rates, sector exposure, and macroeconomic scenarios, and they make decisions that affect millions of accounts simultaneously based on what those models project. Right now, those models are projecting rising delinquencies in consumer credit, specifically in auto loans, credit cards, and personal loans. The delinquency rate on credit card balances over 90 days past due hit 3.1% in the fourth quarter of 2025, the highest level since late 2010. That is still below crisis levels, but the trajectory is what matters. The rate has increased for 7 consecutive quarters, and the banks holding this debt know that once delinquency curves inflect upward, they do not flatten quickly. They accelerate. The second data point driving this contraction is the debt service ratio for U.S. households. As of the third quarter of 2025, the household debt service ratio, which measures required debt payments as a percentage of disposable income, reached 10.8%. That is above the long-term average of 10%, and it is rising because interest rates on variable rate debt have repriced higher while household income growth has slowed. For retirees and near retirees, this matters even more because debt service ratios do not decline automatically when you retire. If you are carrying a mortgage, a car loan, or revolving credit card debt into retirement, those obligations remain fixed while your income shifts from wages to Social Security, pensions, and portfolio withdrawals. The ability to service that debt becomes more sensitive to disruptions, and banks model this risk when setting credit policy. The third driver, and this is the one most people are not tracking, is the student loan repayment restart and its ripple effect on household cash flow. Federal student loan payments resumed in October 2023 after a 3-year pause, and the impact on consumer spending and credit utilization is now showing up in the data. Millions of households that were not making student loan payments between 2020 and 2023 are now allocating $200, $400, $600 per month back to those obligations. That money is coming out of discretionary spending, out of savings, and in many cases, out of credit card availability as balances rise. Banks see this in their internal data before it shows up in public statistics. They see average balances increasing, minimum payments rising as a share of available credit, and utilization rates creeping toward levels that historically precede charge-offs. And their response is to reduce exposure before the losses materialize. This is rational risk management from the bank's perspective, but it creates a liquidity trap for households that were relying on that credit as a financial buffer. Now let's connect this to retirement planning, because the intersection of credit contraction and retirement timing is where the consequences become most severe. If you are between the ages of 55 and 70, you are in what financial planners call the retirement red zone. This is the period where sequence of returns risk is at its highest. A market downturn in the years immediately before or after retirement can permanently damage your ability to sustain withdrawals over a 30-year retirement horizon, even if the market eventually recovers. The traditional mitigation strategy for sequence risk is to hold a cash buffer, typically 12 to 24 months of living expenses, so that you are not forced to sell equities during a downdraft. But many near retirees do not have that buffer. According to the Federal Reserve's Survey of Household Economics and Decision-Making, 37% of non-retired adults age 60 and older reported they had less than 3 months of emergency savings as of 2024. For these households, available credit has functioned as a de facto emergency fund. A home equity line of credit, a high-limit credit card, a personal line, these have served as liquidity backstops that allow households to smooth over income disruptions or unexpected expenses without liquidating long-term investments at the wrong time. But if the banks are systematically reducing those credit lines, that backstop disappears. And it disappears at the exact moment when market volatility, inflation persistence, and interest rate uncertainty are all elevated. Let me give you a specific scenario so you can see how this plays out in practice. Assume you are 62 years old. You plan to retire at 65. You have $800,000 in your 401k. You own your home with a remaining mortgage balance of $120,000, and you have a home equity line of credit with a $50,000 limit that you have never used but keep available for emergencies. You also have a credit card with a $25,000 limit that you use for monthly expenses and pay off in full. Your plan is to delay Social Security until age 70 to maximize your benefit, and you intend to live off 401k withdrawals and some part-time consulting income until then. Now assume the equity market declines 25% in the year before you retire. Your 401k is now worth $600,000. At the same time, your bank reviews its loan portfolio, sees rising credit risk in your age cohort and geographic region, and reduces your home equity line from $50,000 to $15,000. It also reduces your credit card limit from $25,000 to $10,000 based on a model that flags lower future income. You have not missed a payment. Your credit score has not changed, but your available liquidity just contracted by $50,000 at the exact moment you can least afford it. If an unexpected expense arises, a medical event, a home repair, a family emergency, your options are now constrained. You either pull money from your depleted 401k, locking in losses and reducing your future compounding base, or you delay retirement and continue working, hoping the market recovers. Both options are suboptimal, and both could have been avoided if you had understood that credit availability was not a permanent feature of your financial plan. This is not a hypothetical. This is the scenario playing out for households across the country right now, and the banks are making these decisions based on data trends that households cannot see until it is too late. Let's talk about the historical precedent, because this pattern is not new. It happened in 2008 and 2009, and the mechanics are almost identical. In the lead-up to the financial crisis, consumer credit availability expanded aggressively. Home equity lines were marketed as flexible financial tools. Credit card limits were raised automatically, and households borrowed against those lines, assuming the credit would remain available. Then the crisis hit. Banks saw losses accelerating in mortgage portfolios, and they responded by cutting credit lines across the board. Home equity lines were frozen or reduced, even for borrowers who were current on payments. Credit card limits were slashed, and millions of households that had been using revolving credit to manage cash flow suddenly lost access. The Federal Reserve data shows that total home equity lines of credit outstanding declined from $714 billion in 2008 to $510 billion by 2011, a contraction of nearly 30%. For retirees and near retirees who had been counting on those lines as part of their income strategy, the impact was immediate. They were forced to sell assets into a down market. They had to reduce their standard of living, or in some cases, they re-entered the workforce out of necessity. The lesson from 2008 is that credit availability is pro-cyclical. It expands when the economy is strong and risk is low, and it contracts when the economy weakens and risk rises. But for individual households, the contraction happens at the worst possible time when liquidity is most needed. We are now seeing the early stages of the same cycle. The conditions are different. We do not have a housing bubble collapse. We do not have a banking solvency crisis. But we do have record household debt levels, elevated interest rates, and a consumer credit portfolio that is showing stress in multiple categories simultaneously. Auto loan delinquencies are rising. Credit card charge-off rates are increasing. Personal loan default rates are ticking up. And banks are responding the way they always do in this environment. They are reducing exposure, tightening underwriting standards, and cutting credit lines preemptively. For households in the retirement red zone, this means the assumptions built into retirement plans 2 or 3 years ago are no longer valid. The credit line you were counting on may not be there. The home equity buffer you plan to tap may be reduced or frozen. And the flexibility you assumed you had to manage sequence risk is being taken off the table by decisions made in bank risk committees that you have no visibility into and no control over. So what do? The action framework here is built on 3 principles. Reduce reliance on credit as a structural component of your retirement plan. Lock in liquidity before it is reduced. And stress test your income plan against a scenario where credit availability contracts by 50%. Let's break that down into specific steps. First, if you currently have unused credit lines, home equity lines, credit cards, personal lines, and those lines are part of your contingency planning, you need to evaluate whether to draw on them now and hold the cash in a liquid account. This is not about going into debt unnecessarily. This is about converting a contingent asset into a tangible asset before the bank takes the option away. If you have a $40,000 home equity line that you have never touched, consider drawing $20,000 or $30,000 and placing it in a high-yield savings account or a money market fund. You are paying interest on the borrowed amount, but you are guaranteeing access to that liquidity. The cost of carry, the difference between what you pay in interest and what you earn on the cash, is the price of the insurance. And in an environment where credit lines are being cut without notice, that insurance has value. Second, if you do not currently have a cash buffer and you are within 5 years of retirement, building that buffer needs to be the top priority in your financial plan. The target is 12 to 24 months of essential expenses held in cash or cash equivalents. This is not money that sits in your brokerage account in a bond fund. This is money in a savings account, a checking account, or a treasury money market fund that you can access within 24 hours without selling anything. This buffer allows you to weather a market downturn, a credit contraction, or an income disruption without derailing your long-term plan. If building that buffer requires reducing contributions to retirement accounts temporarily, that is a trade-off worth making. Tax-deferred growth is valuable, but liquidity in the red zone is more valuable. Third, you need to stress test your retirement income plan against a zero credit scenario. Sit down with your planner or run the numbers yourself and ask what happens if all available credit disappears the day you retire. Can you still cover your expenses? Can you still manage a market downturn without selling equities at a loss? If the answer is no, then your plan has a structural vulnerability that needs to be addressed now. This might mean delaying retirement by 12 or 24 months to build more assets. It might mean adjusting your spending assumptions downward. It might mean taking Social Security earlier than planned to create a guaranteed income floor. There is no universal answer, but the exercise of stress testing forces you to confront the assumptions that may no longer hold. Fourth, if you are carrying credit card debt or variable rate debt into retirement, eliminating that debt needs to be prioritized over almost everything else. The debt service obligations do not go away when your paycheck stops, and the interest rate risk on variable debt is now a real factor. Credit card rates are hovering between 18% and 24% for most borrowers. If you are carrying a $15,000 balance at 21%, you are paying over $3,000 a year in interest. That is $3,000 that has to come out of your retirement income, reducing the amount available for everything else. Paying down that debt aggressively, even if it means reducing discretionary spending or delaying a major purchase, improves the structural stability of your retirement plan. Fifth, and this applies specifically to home equity lines of credit, if you have a HELOC that is currently open but not fully drawn, check the terms. Many HELOCs have clauses that allow the lender to freeze or reduce the line if property values decline or if the borrower's financial situation changes. In a rising rate environment where home prices in some markets are softening, banks are using these clauses more frequently. If your HELOC is critical to your plan, read the terms, understand the conditions under which it can be modified, and consider locking in access before those conditions are triggered. The broader point here is that credit availability is not a right. It is a privilege that banks extend based on their assessment of risk and profitability. And when systemic conditions shift, that privilege is withdrawn, often with little warning and no recourse. For retirees and near retirees, this creates a planning problem that cannot be solved after the fact. You cannot go back and build a cash buffer after the market has dropped and your credit lines have been cut. You cannot restructure your debt after your income has shifted and your refinancing options have disappeared. The time to act is now, while you still have optionality, while credit is still available, and while the consequences of inaction are still theoretical rather than real. One more mechanism you need to understand, and this connects to the larger picture of what is happening in the credit system. The reduction in credit card limits is not happening in isolation. It is part of a broader tightening in consumer credit that includes mortgage underwriting, auto loan approvals, and personal loan availability. Banks are responding to the same macro signals: rising delinquencies, elevated debt-to-income ratios, and uncertainty about the economic outlook. And they are tightening across all product lines simultaneously. For households, this means that if you need to refinance a mortgage, if you need to finance a vehicle, if you need to take out a personal loan for any reason, the approval standards are stricter and the terms are less favorable than they were 18 months ago. This is the credit contraction cycle in motion. It starts slowly, with small adjustments that seem reasonable. A slightly higher rate here, a modestly lower limit there. But it accelerates as delinquencies rise and as banks reprice risk across their portfolios. And by the time the contraction is widely recognized, the best options are already gone. The households that acted early, that built liquidity, that reduced debt, that locked in credit before it was cut, those are the households that navigate the cycle successfully. The households that waited, that assumed their access would remain stable, that trusted the system to be there when needed, those are the households that face forced decisions, reduced flexibility, and suboptimal outcomes. This is not fear-based planning. This is pattern recognition. It is understanding that the financial system operates according to incentives, and that those incentives shift when conditions change. Right now, the incentives for banks are shifting toward risk reduction, balance sheet protection, and preemptive tightening. The incentives for households, especially those in the retirement red zone, need to shift toward liquidity, debt reduction, and self-reliance. The question I want you to answer, and you can reflect on this privately or in the comments, is this: how much of your retirement plan currently depends on the assumption that credit will be available when you need it? And if that assumption is wrong, what does your plan look like? That question is not rhetorical, it is diagnostic, and the answer will tell you whether you have work to do or whether you are already positioned for what is coming. If you found value in this breakdown, if it gave you a framework for understanding a mechanism that is not being discussed in the retirement planning industry with the seriousness it deserves, then follow this channel, because we are tracking the structural shifts, the policy changes, and the data points that affect real household finances in real time. This is not entertainment. This is not optimized for the algorithm. This is analysis built on the principle that understanding how the system works gives you the ability to make better decisions before the options narrow. The credit contraction is happening now. The banks are acting on information you do not have. And the gap between what they know and what the average household assumes is where the wealth transfer occurs. Stay informed. Stay ahead of the curve. And build your plan on facts, not assumptions.